Stop everything. Small silver investors must watch this now. Michael Oliver. Michael Oliver just broke his silence. And what he revealed about silver's technical breakout will change everything you thought you knew about this market. While Wall Street tells you silver's overdone, while COMEX shows $73 per ounce, Oliver's charts are screaming something completely different. Something the big institutions don't want you to see. Small investors holding physical silver right now, you need to hear this before Monday opens. Because what's happening in the spread charts has only occurred twice in the last 50 years, and both times. Welcome to Currency Archive, where we bring you the financial truths that matter most in these uncertain times. My friend, if you've been searching for honest analysis, without the noise, without the hype, just pure strategic intelligence, then do me a favor, hit that subscribe button right now. Because at our age, we don't have time for nonsense. We need the facts, and we need them fast. And tell me in the comments, where are you watching from today? New York? Texas? Maybe overseas? Let's build this community of serious investors together. Silver isn't just breaking out, it's breaking the rules. In a matter of weeks, it's gone from a quiet sleeper to the most volatile headline-grabbing metal in the financial world. But while the mainstream scrambles to explain the chaos, one man saw it coming. Michael Oliver. A veteran market analyst with a track record of calling major momentum shifts, says this is only the beginning. And if he's right, we're about to witness one of the most explosive silver runs in history. This isn't just another rally. According to Oliver, silver is entering what he calls a new reality. Not $50, not even $70. He's talking triple digits, and he's not alone. Because underneath the surface of these wild price swings lies a seismic shift, one that's been building for years and is now finally erupting. So what triggered this move? Why is silver behaving like a coiled spring finally let loose? And how high could it really go? Stay with me, because what's happening in the silver market right now might just be the financial story of the decade, and you're not going to want to miss it. Michael Oliver has a fascinating perspective on silver that cuts through all the noise. He loves it when financial networks scramble to cover silver, but only when it drops hard. His son Brett monitors everything going on across the internet, the advisors, the commentators, all of it. And here's what they've noticed. Rarely do mainstream outlets cite the fact that silver has been exploding for quite a while, especially this past month. But when it drops big, oh, there's the headlines. That's when everyone's attention gets drawn in. And there are all kinds of stories that surround silver, some of which are true and some not. Stories about this institution doing this, or that exchange implementing new rules that'll supposedly wreck the whole market. But you've got to be aware of what's underneath this beast. Oliver's assessment, and so far they're right, is that silver is going to a new reality. Silver's not going to have another $50 up move out of the range from 0 to 50, basically stuck there for 50 years. Then go up and have everybody naturally think around 100. Oh, that's just a swing move. You know, the dimension of the prior base. Oliver thinks we're going to a new reality in the hundreds of dollars, and he thinks we're going to do it in about 6 months. His clock started at the close of November. At that time, the price of silver was in the mid-20s. It was based on a signal they got from their relative performance analysis, spread chart analysis of silver versus gold versus the S&P, gold miners versus gold. All of these metrics said, uh-oh, we just shifted in a big way on a relative performance basis. When that occurred in '79, in the rush to the 1980 high, and in 2010 leading to the rush to the 2011 high, big multiple gains in 6 months, that spread broke out, silver versus gold. They've had a situation since 2020, basically, of silver sort of underperforming gold. It's going up in price along with gold, but less so. And therefore, the spread relationship has been like a capped-off ceiling. You broke through the cap at the November close. Now, and sure enough, if you use that as your metric, and it said this is just the beginning of a massive shift of silver versus gold and also of net price, then the clock just began there. So it's not old, it's fresh. And their argument, looking at lots of metrics, is that the moment everything changed wasn't when silver hit $84 or when it snapped back up after a vicious sell-off. It was the end of November. That's when Michael Oliver's models triggered a major alert. But this wasn't about price. It wasn't about headlines. It was something deeper. Oliver tracks momentum, specifically the relationship between silver and other key markets like gold, the S&P 500, and gold miners. And what he saw in late November was a massive structural breakout in the silver to gold spread. For years, silver had lagged gold, caught in a frustrating range. But then, snap, the cap broke. Silver didn't just outperform, it exploded through a multi-year ceiling of resistance. According to Oliver, this type of spread breakout only happens at historic inflection points. He points to 1979 and 2010. The last two times, we saw a similar move. In both cases, silver surged multiple times over in just 6 months. That's the clock Oliver says started ticking in November. The price back then, mid-20s? That wasn't the top. That was ground zero. Everything since has been confirmation. And if history is any guide, this breakout isn't noise, it's the signal. The kind of signal that rewrites the script for the entire precious metals market. Silver is likely in the next 6 months to minimum reach a couple $100, and possibly more than that, in going to a new reality, not this 50-year range it's been confined in. Most commodity markets have not been confined in that sort of range. Copper hasn't, lead hasn't, but silver has, and it's saying no more. And it's not going to do it in a slow staircase corrective process manner. So what Oliver has stressed to his subscribers for some time is that you've got to somewhat ignore the type of events that just happened. Usually it takes a week or so and you get 10 or 15% pullback, and then it takes you a couple months to go up and take out that high. That's not what's happening here. Look back at October as a good example. They hit a high and had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked, but still it was a pretty fast recovery given some of the other behavior of silver over the last few years. This time, it was a 24-hour event. Silver went from a futures high at 82, dropped down almost to 70, and turned around the next day and hit 78. It didn't fool around. It didn't base. It didn't prove itself as support before it turned up. It just said, bam, back up. In fact, it's back up trading now above the high close that occurred, the high settlement price on Friday. So this is the kind of behavior that investors need to be aware of. It is going to be part of this explosive advance, and you just don't get upset by it. In fact, if you try to get out, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go, whoop, right back up, and you'll say, what do I do now? So anybody who got out yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now, in about 6 months, Oliver will be trying to define a place to then get out after silver has reached a new reality, because there will be a major correction at some point. But he doesn't think you're going to see it until well into the second quarter. What happened next caught everyone off guard, except Michael Oliver. On the surface, it looked like chaos. Silver surged to nearly $84 in overseas trading, only to crash down to 70 and bounce right back up to 78, all within 24 hours. To most analysts, that kind of volatility screams danger. But Oliver saw something else. He saw acceleration. In his view, these violent swings aren't signs of weakness. They're signs that silver is now operating under a completely different set of rules. The traditional pattern, rally, pullback, slow grind higher, that's gone. This market isn't waiting around to build a base or confirm support. It's snapping back instantly, reclaiming losses with a speed that punishes anyone who tries to trade in and out. And that's exactly what makes it dangerous. Not for those holding, but for those hesitating. The people who sold during the drop were already underwater just a day later. There was no time to re-enter, no clean second chance. It's the kind of behavior Oliver has warned about for months. Sudden drops, followed by even more aggressive surges. All part of a fast-moving revaluation. This isn't a healthy correction, it's a tectonic shift. And as Oliver puts it, once these momentum dynamics are set in motion, they don't stop halfway. They build, they intensify, and then they break through everything in front of them. When the spread broke out last month, forget the net price of silver or gold, quit looking at their charts. But when that relative performance spread broke out, it broke through a multi-year high, a point where silver had continually gone to bump against the price of gold, where it created a ceiling of resistance that it couldn't perform better than that level. When it broke through last month, silver was up $22 on the month, 1 month. It's already been in a bull market. Why did it suddenly go up $22 in 1 month? The spread said, the game has changed, and Oliver thinks the game will continue for a couple quarters. And once it's over, we'll look back and say, oh golly, wish I were there. Well, the way to stay there is to stay long, until certain metrics that they're monitoring say, okay, now we've maybe reached the level and probably even overshot a reality level. So if silver is justified to be a couple $100 an ounce, like if you take M2 money supply and go back to 1980 and factor in the money growth, depreciation, and the buying power of the US dollar, and then calculate to where silver might be, it'd be a couple $100 probably. There's no question about that. But if that's where it's going, it's likely to overshoot it, as most markets do. If they've made a big mistake, they often overshoot the correction of the mistake. And so be ready for that. There's another thing going on with silver that people seem to be focused on silver itself. like the industrial supply-demand deficit that's been around for 5 years now. Why didn't it work 3 years ago? Well, suddenly it's starting to work. You don't have enough silver to meet demand, especially high-tech demand, and everybody's focused on those aspects of silver. And also, they're all panicked by the potential that, oh my gosh, the CME will raise the margin requirement. Well, they've been raising it all along. In fact, there was like a 13% jump on Friday where they raised the margin rate. And in 1980, the chairman of the COMEX, who Oliver knew because he had trained him at E.F. Hutton, Oliver worked under him. He was the head of Hutton's commodity division in the mid-70s, but he stayed the chairman of the COMEX through 1980, and he imposed no seat buy orders. Silver's at $50. It had gone from about $3 to $50, and the market crashed. They think, all they have to do is somebody on the outside, like in an exchange here or there, can push a button and stop this bull market. They don't realize what's really underneath the surface here. It's not merely exchange margin rates that are causing silver to go up too much. It's that industrial supply aspect. But it's also primarily the monetary issue. Silver is money. It's been money for 3,000 plus years, along with gold. The poor man's gold, and also money recognized by various governments, including ours at one point. So that is what's going on. And there's bigger issues that are underlying that continue to drive, for example, gold. The issue of these dangers that exist and are about to implode and create even more central bank panic and printing. And that's the real driver under silver and gold. Now, the fundamentals backing this move aren't just strong. They're historic. For 5 straight years, silver has been in a structural supply deficit. That means global demand has outpaced supply every single year, draining above-ground reserves and tightening the physical market. And this isn't just about investors. It's industrial. Silver is a critical component in solar panels, electric vehicles, semiconductors, and high-tech medical applications. It's the metal you can't replace. The solar industry alone is consuming silver at an accelerating pace. And with green energy mandates sweeping across the globe, that demand isn't slowing down. But here's the twist. While industrial demand is exploding, mining supply is stagnant or even declining. New projects take years to bring online, and many of the high-grade silver mines are already exhausted. That's a collision course, surging demand meeting constrained supply. Now, layer in the monetary angle. Silver isn't just an industrial metal, it's money. It has been for over 3,000 years, and as central banks around the world race to devalue their currencies, that legacy is coming back into focus. Investors are waking up to the fact that silver, like gold, is a hedge against monetary chaos. So now you've got investment demand piling on top of industrial demand, all while supply continues to shrink. It's not just a bullish setup, it's a pressure cooker. And once that lid blows, the repricing won't be gradual, it'll be explosive. But there's something even bigger happening beneath the surface. President Williams of the New York Fed, a month or so ago, gave a press conference or speech, and he said that the Fed is going to start, quote, buying bonds. And he didn't say he was going to do it to support that market. His excuse was to provide liquidity. Because it's been a fairly illiquid market and they want to provide liquidity, like a little technical issue or something. Instead, the issue is the fact that on the long end of the US government debt market, you've had no recovery, no drop in rates, no recovery in the price of the bonds for 3 years. T-bonds crashed in price between 2020 highs, around 190 price level on the 30-year bonds, down to 117 by October of 2022. And if you look at a T-bond price chart or a yield chart the other way, it's gone sideways for 3 years. In other words, there's no recovery in bond prices. They've been trying to base. There have been repeated rallies, 3 big rallies that can be measured, and they haven't been able to get off the ground. So T-bonds right now are in the 115s. They're still below the low of that crash low in 2022. That's how anemic they are, which means rates are staying high on the long end, which is choking to a lot of entities. Corporations, commercial real estate, for example, they need relief, not on the short end, but on the long end, and they're not getting it. And that T-bond market, technically, to Oliver, now looks like it's vulnerable for a downside in price, upside in yield. If you slip about a handful of points from where you are now, they're at 115 plus. You get down around 111 on the T-bond futures. Right now, the T-bond March contract is trading 115 or so. That's not a big drop. But you drop that small amount, and they're going to start to blow momentum structures that say, uh-oh, we're headed into another dive. The Fed can't stand that. The economy can't stand that. This is bigger than the stock market. Everybody in the stock market's all jubilant about this or that, or AI, or whatever. Oh, this sector's finally doing well. They're They're not looking at the T-bonds, the Fed is, and the Fed's already spending money, printing money, to keep that market from doing something that it's likely to do. And that's the factor underlying the monetary metals. Because if you lose faith in government bonds, US, Japanese, UK, etc., they're all in trouble. Then the public says, what? What do I do? Where do I put my money that's, quote, safe? Because frankly, the stock market will follow that. If bonds start to break, the stock market's going to get gut kicked. And Oliver thinks it will be. It's topping in his process anyway. Since January this year, the broad stock market is making a topping process, but those factors have yet to come into play. And when they do, what's that going to do to monetary metals? Massive fuel injection. Forget $50. That number is already obsolete. According to Michael Oliver, we're not just headed for a higher silver price. We're leaving the old paradigm behind entirely. For decades, silver's been boxed into a range between 0 and 50. It flirted with breaking out in 1980 and again in 2011, but each time it was slammed back down. This time, Oliver argues, is fundamentally different. His analysis points to silver entering a new reality, a zone where triple-digit prices aren't just possible, they're inevitable. He doesn't see another short-term spike. He sees an entirely new valuation structure forming, one that reflects decades of suppressed momentum now being violently released. And he's not pulling numbers out of thin air. When you adjust for things like M2 money supply growth, inflation, and dollar devaluation since the 1980s, silver's fair value could already be somewhere north of $200. But here's the catch. Markets don't stop at fair value. They overshoot. They get irrational. They correct too far in the opposite direction. So if $200 is justified, Oliver believes it could go even higher before this run cools off. And here's what makes it even more compelling. Unlike copper, lead, or gold, silver has been uniquely trapped in this decades-long range. Now that it's breaking free, it's not looking back. The breakout has already begun, and it's rewriting the boundaries of what silver can be. Let Oliver put it this way. Let's talk about gold, the mama market right now. Since legalized in 1975, gold's had two major bull markets. One from the 1976 corrective low just above 100. It rose to 850 in 3.5 years. That's an 8-fold gain, 8 times the bear low, 2001. After lengthy pullback and then basing at a price of around $260, it finally bottomed and turned up and went to 1/1920. Another 8-fold move. Took it 10 years, different time span, but the same multiple gain. The conditions then weren't anywhere near like what we're talking about now, the fundamental underlying stability issues. Well, gold made its bear low in December 2015 at a price of 1,050. We're fourfold, only half as much gain on a multiple basis as were those two prior measurable markets. So, yeah, when you look at an arithmetic chart, it looks like, oh my gosh, it's been parabolic. No, it's only half as much strength as exhibited between 76 and 80 and 2001 to 2011. So if gold even just matches those multiples, it would be well over $8,000. That's just matching those. That's not exceeding. Oliver doesn't set that as a target. He's just pointing that out. Frankly, he thinks if it ever got there, you'd go way beyond. And also, he thinks the next outcome of this situation that is a bit unfolding and will suddenly now more rapidly unfold, Silver's stating that you'll have fundamental factors that smack everybody in the face, like jeopardized government bond markets, central banks out of control, and you'll find gold and silver possibly being monetized. This country, that country, this country, and what will drive that is the pain that hits the public in these various countries, and also their sense of uncertainty. And the one thing that makes them feel certain is a growing affection for the monetary metals. So Oliver thinks once this next bull occurs, it's not likely to collapse. It's likely simply to become institutionalized. It's already becoming that way. We're close to that in certain countries in the world. And if this crisis hits as they think it will, it's going to be far more broad. Even the Western countries will suddenly have to rethink their notion of what's acceptable. What's a good norm to proceed on? Is it still central banks playing their boom-bust games? You know, every other year or so they inject money. The stock market goes up, and suddenly it busts and they inject more money. You get the point. And so Oliver thinks we'll have a rethink, where instead of a, quote, bubble top, yeah, you'll have some sell-off. But he thinks you're going to likely be institutionalized at much higher levels. And a lot of that movement could occur this coming year. So where is all this going? Michael Oliver says we're heading into a new reality. And the key word is new, not just higher prices, not just another boom and bust cycle, but a redefinition of what silver is worth in a world that's breaking from financial convention. In his view, Silver isn't just reacting to supply and demand, it's responding to something bigger, a shift in global confidence, confidence in fiat currencies, in central banks, in the idea that paper promises hold real value. And as that confidence crumbles, silver is reclaiming its role, not just as a metals, but as a monetary anchor.